And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Today I'm joined by Todd Rosenbluth, head of ETF and Mutual Fund Research at CFRA, Tom Lydon of ETFtrends.com. Welcome to you both. Let's start with the latest ETF milestone that's got everybody talking. You've heard us cover the rise of low-fee ETFs. How about one that pays you to invest? Yeah, you heard me right. Salt Financial launched the Low True Beta ETF last week. This is the first ever, if it goes through, negative fee ETF. It's designed to target low volatility stocks, but that's not what's attracting so much interest. Check this out. On the proposal for the first $100 million brought into the fund, they are not going to charge anything. In fact, they are giving money back to investors, about $5 for every $10,000 invested, 5 basis points. So it's a new twist on an old way of drawing investors in, but will it work? Todd, let's start with you, and I want to make it clear, as of now, it's 29 basis points is the fee. They've got an application in to essentially give the rebate. We'll see if that goes through, but still, it's a very novel idea. Is it going to work?
So I think what's interesting is SALT has an existing ETF product. It trades under the ticker SLT. It has $14 million despite launching 10 months ago. JP Morgan's gathered billions and billions of dollars with their own products that are low cost that's there. So if you lower the fee or give it away for free, it doesn't mean investors are going to come in the door. They're probably going to take a look around, see how that compares with other iShares, Vanguard, State Street products as well.
And Tom, he's right. I mean, for example, I note here we had JP Morgan launched an ETF recently. They attracted $25 million in fees, and they charge it 2 basis points. Are we at the point where it doesn't matter, 1 basis point, 2 basis, 3 basis points? What matters is, do you have a product that isn't available that somebody wants, or do you have a base like JP Morgan where you've got a ton of potential investors just sitting right there at your doorstep?
Yeah, well, I think the executives of SALT are brilliant because is it a marketing ploy? Maybe, but it's probably a great one because all the money is going into low-cost ETFs. And if all of a sudden they hit that $100 million mark very quickly because they're financing this, good for them because now they're going to be available on platforms that you normally can't get available on Morgan Stanley, Merrill Lynch, unless you have $100 million.
We don't mention that very often, but that does exist. There are minimums that many of the platforms have.
Absolutely, and getting through the gatekeeper is key, and assets are a big thing. But on top of that, when you look under the hood, it's actually a great strategy. When you look at other low volatility, smart beta strategies, it really is good, and that will help get it attention.
Now explain to me how this works. Right now, they're still charging 29 basis points to get in. They have an application.
Right.
If it's approved, from that point on, do I suddenly get money put into my account? Right now, if I put money in now, they're still charging me 29 basis points.
Right, on a day-to-day basis. So obviously the expense ratio is over the year. So if you're not in for the whole year, then you wouldn't be charged at 29 basis points. So it is a gradual thing. And we've seen fee cuts coming down. Vanguard, we talked about earlier, I believe. Vanguard brought its fee from 4 basis points to 3 basis points for VOO.
So is this a lot of silliness at this point? Now that we finally got a -1, we finally crossed over. We went from 9 to 3. Now there are a few at 0 out there. Now we have a -1. At what point, when should we start concentrating on other issues? And
I think we should be concentrating now.
With our mouth open, looking at this.
I think you're going to see more people try this because if you can finance a launch that's going to get you to 100 million, you got a better chance of getting to $1 billion. The biggest challenge is getting to that first $100 million.
Right, and I think the difference between this product that came out and SPLV from Invesco, from USMV, from iShares that are minimum or low volatility products, the devil is really in the details when you look inside the product.
I'm going to bury the whole low fee story. I think we're over it. Once we've got into the -1s, I think we can find another topic to move on to. In fact, let's talk about gold right now. The precious metal had a strong start to the year, but it's lost some of its luster since then. It's now up only 1% for 2019. It was up 12% for the S&P, excuse me, was up 12% so far this year. But there are a number of low-cost ETFs focused on the yellow metal. Granite shares and the Aberdeen Standard charging just 17 basis points. The iShares Gold ETF at 25 basis points. The Spider Gold ETF, the highest, and that's at 40 basis points. Joining us now, Will Ryan. He's the CEO of Granite Shares, one of the low-cost ETF providers in the gold space. Thanks for being here today, Will. So I think the important thing is you've attracted assets. I mean, low fees, back to the subject again, low fees really does bring in assets. But is it all just about the low fees? Are they all essentially the same, the gold funds?
They're very, very similar. And yes, for a lot of people, the fees will be the most important thing. So when we first did this, You had gold ETFs at 40 basis points, for example, that was the highest, and 25. And we came in with the lowest cost gold ETF for bar. And I think a lot of people will focus on that, as they rightfully should, because low fees are important. But we also added other differentiators like holding the gold in a different location to other ETFs, having audit checks 2 times a year, for example, into the vault, where we send people in and actually check the bars and reconcile that against the bar list. So there are other ways in which we do that.
But it's still the basic idea. There's gold in a vault. It is audited, so
Yes.
all those people who say there's no gold in the vault, like how many years? Remember we did that special many years ago?
You've been in the vault.
Yeah, Will was at the World Gold Council many years ago. I'm one of the only people to ever see the gold anywhere. It's definitely in the vaults. At least it was in the wall I saw. But the point is, people still want gold. The vault is in
London.
In London,
Yeah.
okay, in different location than most of the other vaults, right?
Yeah, and people hold gold in different locations because that is the global market. So you can have gold in different locations, but London is the center of the gold market. So when we talk about the price of gold and we talk about an ounce of gold that we're seeing on CNBC, that's an ounce of gold that's stored or settled in one of the 4 clearing vaults in London.
Now, gold's only up 1% this year. Equities are up 12%. Can you still make an argument for investing in gold as a counter-cyclical investment? Because we've seen gold underperform for long periods while stocks outperformed. Make a case for owning gold right now.
Well, I think you saw it at the end of last year when the stock market sold off pretty dramatically and gold price went on a pretty significant rally. Now that's come back a little bit because you've had the stock market suddenly regain. You've had a bit of a V-shaped recovery in the market, but gold prices selling off. This could well be a buying opportunity for gold at this point. The world is slowing down. That is what we know for sure. And in that environment, that's a weaker dollar platform in my mind. One of the key things that helps drive gold prices. So for me, I think look at this price and think about defensive positioning.
I want to get you to in a moment, but it's not just investor demand or inflation concerns. Global demand, particularly India and China, really motivates gold prices. What's demand like in China, where it's slowing down, and India, where the households of India own it as a wealth hedge?
So demand is picking up and has been, because remember in China, you've got easing going on, and obviously in that economy, and Chinese investors don't have the kind of optionality or the variety of choice that we do here. So Chinese investors pretty much have real estate and gold as the options if they want to move out of their domestic currency. So gold actually typically gets a bid when you have inflation running in the Chinese economy, which is what we have at the moment.
Okay.
And
Guys?
Yeah,
go ahead.
2 points. First of all, during recessionary times, gold tends to do better. So if you look back during the financial crisis, you look back in the early 2000s, those were great times to own gold. And if you feel like this market might be a little bit long in the tooth, we might be in recessionary times in 2020, that's something to consider from a hedge standpoint. On top of that, you hit it. Supply and demand is key. Demand is really strong right now, but supply, it's difficult. It's really tough to get an ounce of gold out of the ground. Talk about that.
Well, you've got some of the mega mergers going on, obviously, in the stock space, and that's exactly what's happening. Companies can't find these big new gold finds out there, so they're buying each other's capacity. And so that's why you're seeing these mega mergers going on in the space. And that goes to your point that we don't have to talk about peak gold, but what we're saying is there are no major new discoveries, and therefore supply is going to be more constrained.
Well, I think what we've seen also is that you've got 2 ends of the gold ETF spectrum. You've got GLD, which is the 800-pound gorilla, a lot of liquidity in that for people who are institutional-oriented, and then you've got more retail-oriented products. So BAR has now gotten over the hump for assets under management. It trades over 100,000 shares on a daily basis. So there's liquidity here, too.
I want to move on, but I just 20 seconds. Commodities have underperformed for years and years and years. Is there any hope outside of the gold? You own a commodity ETF, COMB is the symbol. Any hope for commodities this year? Finally, it would be up in at least the top 10 performers?
So I think the January 30th is a big thing. So the Fed meeting, basically, to me, engineering a policy which could result in an inflation overshoot. Inflation is not something that anybody is really talking about, but I think it's a risk that is worth considering. If we start to get inflation pressures increasing as we've started to see over the last few years, commodities could rally on that basis.
It's been a tough performer for many, many years. Stay with us, Will. It's time for a little myth busting. This is my favorite part. An active manager is a better manager. How many times have you heard that? How many active managers have we had on saying that? But wait a minute, not so fast. The reality is active managers continue to underperform their benchmark. The S&P Dow Jones Indices published its annual SPIVA report last week, again, showed that even with heightened market volatility last year, active managers struggled to outperform. Over the long-term horizon, such as 10 or 15 years, look at these numbers here. The performance is even worse. 85% of large-cap managers underperformed after 10 years, and almost 92% underperformed after 15 years. That's terrible. And in this case, size doesn't matter. The same dismal numbers apply to small and mid-cap fund managers. It doesn't matter what you look at. More than 85% of those guys also underperform. Look at these numbers. Todd, S&P has been doing this for 16. This didn't just happen. They've been doing this for 16 years. The results are consistent. What does this tell us about the inability of the active managers to outperform? What's the conclusion?
So for most of the funds that underperform, the reason is because of the fee. So you now have, as we talked about, 3 basis point exposure to get to the S&P 500. The average actively managed fund charges 100 basis points or more. In the small cap space, which is supposedly where you find hidden gems, the numbers you highlighted earlier are stark examples. Yeah. You can find good active managers. Yeah. It's just hard to consistently do that.
And Tom, this was Jack Bogle's central insight more than 30 years ago, that even when you get good active managers, and Vanguard had excellent and still does have excellent active managers, he was not opposed to active managers, but even when you get them, the fee they charge destroy any alpha that they actually have.
Right. And your point, 92% underperform over the last 15 years. I think active management is going the way of cigarettes. Back in the 70s and 80s, mutual funds were hot. They were rock stars. It was really, really cool. But over time, fast forward to today, active management is not healthy for your financial health. It's not as cool. And it's expensive. To Todd's point,
Will,
it's
you
really
run an
expensive.
ETF, but where do you stand on the active management debate? Do you think it's still possible for people, even in the commodity space, to pick a basket that would outperform?
Active management is like singing. It's a talent. Some people have it, but the vast majority of us don't have it and will never have it. I think that when it comes to this point about longer term, fees, taxes are really important. But for me, it's also the information age has been the biggest game changer. The DIY investor has never been more empowered and has never had more access to data than they do just now. And that is something that just 10 years ago, 15 years ago, didn't happen. And so that information advantage, if you will, has gone away. And I think that's really tough for the active investor.
And what you have also is you have these low-cost products that are tied to the S&P indices that are in here, offered from iShares, from State Street, from Vanguard. But if you did want something that was a little bit active, you could have the smart beta products Tom touched on earlier. You could have a value slice of it. You could have a more low volatility part of that portfolio for 15 basis points or less. And so that bar is not much higher for the smart beta, the quote-unquote active or quasi-active approaches as you'd have for traditional index-oriented products.
Once again, I go back to my mentor, Jack Bogle, who said if it's the fee that matters, if you're going to pick active management, pick the lowest cost that's at the best performer, and that's the real key to the game. Again, Jack was never opposed to active management. They have terrific people. I want to note that this report specifically deals with survivorship bias, because there's these problems with these reports. 50% of the funds close after 10 years because the performance is so bad. So they get excluded from the studies that make everybody who's surviving look even better. And the study corrects for that particular bias. It's a very important methodological aspect of this.
Right. The number of funds that survive within 15 years is a very small number. So the universe...
50% die after 10 years.
Shrinks considerably. So one, you may find someone that outperforms for a year or two, but they're not likely to continue, and they may not be around anymore, whereas obviously the ETF is going to go on in much longer period of time.
Is it any wonder why we talk about ETFs, low cost? People look at me, oh, it's going to blow up someday. Too many people.
And why there's still trillions in actively managed mutual funds, kind of like cigarettes, again. They know it's unhealthy for you, but it's really tough to quit, right?
That's another subject. How sticky that money is over there. That's a subject for another day. We're going to have to leave it, though. We'll bring you guys back to talk about this. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Tom Lydon, Todd Rosenbluth, and Will Ryan for joining us today. Thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday. Same time, same place. Have a good week.